Welcome to Franchise Empires, where aspiring entrepreneurs learn exactly what it takes to become a successful franchise owner, from one location to 10 and beyond. I'm the Wolf of Franchises.
Hey everyone, it's the Wolf. Today on the show, we have a return guest in Erick van Horn. Erick is a former multi-unit franchisee who has now been in the industry for many years. He has his own Facebook group and podcast for franchise industry professionals. And this conversation is one that we're actually jointly using for both our shows. Erick and I chat about what we're up to in the content world, as well as our current ventures, mine with Crockett and his with Front Street Equity. Enjoy the conversation.
The Wolf of Franchises is the CEO of Wolfpack Franchising, as well as a creator at Workweek Media. All opinions expressed by the Wolf and podcast guests are solely their own opinions and do not reflect the opinion of Wolfpack Franchising or Workweek. This podcast is for informational purposes only and should not be relied upon as a basis for investment decisions. The Wolf, Workweek, and Wolfpack Franchising may maintain positions in the franchises discussed on this podcast.
All right, Wolf, welcome back. How do people that don't know you address you?
Most ask me what they should call me. Depending on the setting, I give them my real name, or I just say I go by Wolf half the time.
You go by The Wolf or Wolf?
No. Wolf works. Yeah, it's got to drop the. It's a bit smoother and cleaner.
What about Wolf of Wall Street? What does Jordan do? What does he say? Does he say Wolf
sure,
or The Wolf?
I think he's trying to get away from that brand a little bit after. Yeah, which I started the Wolf of Franchises kind of as a joke, and now it's become a bit more of a serious thing. And yeah, I mean, I do get that question sometimes from like people who discover it, where they're like, "Are you sure you want that association?" But at this point, it is what it is.
It is what it is. Let's go there, man. Like, in franchise, I talk to so many franchisors as they're looking at becoming part of our portfolio companies at Front Street Equity. So young franchisors that are 50 plus locations open, or people that are thinking about franchising. And it's interesting to hear the stories because they start out doing one thing. They might be in one business, they might be in one industry, and then as they progress, they find themselves like with different opportunity that may be even better opportunities. So what has that been like for you as you kind of look back at where you were before to where you are now? What doors have opened up that you were not expecting?
Yeah, no, it's a great question. I think probably pretty common amongst most entrepreneurs, right? They start out with a plan and it doesn't necessarily go to the plan, and then you figure it out along the way. But yeah, I mean, I've been at, I started the Wolf of Franchises. I guess we can start there, right? In July of 2021. It was just a hobby. I was working in franchise development and kind of moonlighting on Twitter and with a weekly newsletter, just breaking down emerging franchises that I found interesting. And I'd say the first opportunity that I wasn't expecting was a media startup called Workweek reached out to me. We've since partnered and been partnered for a while, but they used to work for The Hustle, which was a popular newsletter that got acquired by HubSpot for 25-ish million. So they know newsletters, they know how to grow audiences. So I never expected to get that, like, almost that professionalization of my newsletter and be able to spend full time on just doing content and growing my Twitter audience, which today is at like 122,000, and then the newsletter's now at 40,000, and we have a blog and of course a podcast. So I never expected to like go all in on media. And then secondly, more recently, we launched Crockett, which is a separate entity, a separate endeavor, and it's that's come with its own twists and turns, but it's primarily a financial data management tool for franchisors and all their franchisees. And I'd say that never would have been possible if I didn't go all in on the media and was able to, build an audience, which, today has allowed us. We're about 6 months into the Crockett journey and haven't had to spend a dime on marketing because we just have the organic eyeballs and listeners and followers and the like.
That's interesting how you say media company. I remember having a conversation with Ryan Dice, one of the founders of Digital Marketer, and we were just, brainstorming some stuff. And this was about 7 years ago. He's like, Erick, are you doing this franchising thing, or is this a media company that you're building? I'm like, media company? No, it's not a media company. And I'm like, but I was aware enough to say, what do you mean by media company, and how does that look, and why do you ask that? And then he went in and broke it down, and realizing, boy, a lot of what I do and content out there is really more like a media company. I've not done it at your scale, but I definitely had that frame as I've built content and built on the platforms that I have. And I think probably more franchisors need to look at what could they do in terms of content and thinking more like a media company to build out their brand. So what kind of advice would you give a franchisor? What kind of comments do you have on that for franchisors thinking, maybe I need to have a podcast, a newsletter, more active on Twitter, some of these things?
Yeah, it's a really great question. There's definitely no one size fits all answer, but I mean, I think the benefits are obvious, right? Like I kind of mentioned it for Crockett, right? I can send a tweet. It costs Crockett $0 to get in front of potentially, 122,000 followers. And, the way Twitter's algorithm X's algorithm works, it ends up in a bunch of other people's feed. So you end up getting a lot more impressions than you even have followers. But, right, with how much franchisors pay to acquire a franchisee, that's where my head would be at as a franchisor, is like, and even brokers count as paying to me. Right?
100%.
I think people just kind of think like, oh, it's the franchisee's money. So, but like, hey, that could be money in your bank account. There's an opportunity cost to just, giving up half.
It's acquisition
or 70.
costs. Whether you're paying a broker,
Yes, exactly.
You're paying a media company, or you are the media company putting out content, there's acquisition costs for the franchisee that is your latest and greatest franchisee.
Exactly. And look, I just think like I try to tell any emerging franchisor I'm talking with, just like, hey, do the math on just 10 units. If you kept every franchise fee, and look what happens when you give all those to brokers, which it's fine. Like, I think a blended approach is the right way to go, because there are brokers who are funneling quality candidates. So like a blended approach would be what I would suggest. But, the content, right? I mean, it depends on the industry. I think there's little bit of like good fortune depending on your industry, right? Where if you're a restaurant franchise or like a pet franchise, I mean, that's like very shareable content. So like I would go hard on Instagram, or even I mean, SEO is interesting these days. Like the Google algorithm is definitely like getting so gamified, where every time you search something, you end up on a blog post that isn't actually helpful. And then you have ChatGPT, and people think that's going to crush Google. So I'm not honestly smart enough to even speak to that at this point. But yeah, I would think pick one channel, whether it's a newsletter, a podcast. And I wouldn't recommend podcasts, because I'm sure you know this, Erick. They're very hard to scale relative to maybe other platforms. But I would say pick one, because like ultimately, your job is to sell or to grow your franchise and support your franchisees. Creating like a legitimate media operation just to get to franchisees, it's too much work, and I think it's a distraction. But trying to focus on one channel and grow it organically that relates to your brand and your business, like that's absolutely worth it. But I would just stick to one, keep it simple, and over time that it'll compound. And so I bought in and was like, I'm just gonna do this for a year. I'm not gonna focus on metrics. I'm just gonna head down. Maybe I'll check in once a quarter on my metrics, but like I'm not gonna freak out over every week I only gained like 6 followers, right? So the support system, and then also just the time, because like honestly, I started out, I wasn't good at content. Like my tweets were like not interesting, not entertaining, not even that useful half the time. So there's an art to it. It's definitely not a science with content, but it gave me the time to like, I started to understand, all right, if I talk like this and I tweet this kind of content, like people definitely like it resonates with them and it's more helpful. So it gets more engagement and yada, yada, yada. So I kind of learned the formula for it all.
I think that's why people want advisors, part of their brand. Franchisees want to be around other successful franchisees that could give them really good advice. And especially if they're paid advisors or equity advisors, or like what we do at Front Street, like you have somebody like Workweek that is able to say, hey, chill out. This is not a 2-month game. This is a longer term game. And we've been down this road before, and we know what it takes. So just keep doing what you're doing. I'm sure they had guardrails and kept you focused on the right things. And then at some point, I mean, did it just explode, or did you just look back and think like, oh wow, this is bigger and better than I thought it would be at this point?
There's definitely like inflection points. I think it took me like 9 months to gain 4,000 followers on Twitter. And then I did this thread about Quiznos and how they kind of collapsed over the, last 10 years or whatever. And I gained 9,000 followers just from that thread. So I went from 4,000 to like 13,000 over literally within 24 hours. And then from there, that kind of like, it gets somewhat easier. I used to think it was like a direct correlation that if you just had like 100,000 followers, you could tweet anything and you're going to gain like 500 followers with every tweet. So you still got to put out good stuff. But that definitely made it easier because I had a bigger base to work off of. And then, I kind of found that formula with Twitter threads. And that's really, I mean, looking back, I worked too much. I think that's actually good food for thought if someone's like seriously trying to go in on content. It's addictive. Ultimately, it's not good for your mental health. And like I was living on Twitter. Like, I mean, I was like giving up weekends, working late nights. Like I was living in New York. My office was my bedroom. I would wake up, roll out of bed, get on my computer, and I'd work till midnight. And I'd just get out of my desk chair, and my bed was like 2 feet away, and then I'd go to sleep. It was like, looking back, it was depressing, man. But yeah, so it was a grind, but that was definitely like that first Twitter thread put me on the map. And then I just kept pumping out more every single week. So the consistency was a huge part of it.
All right. So you put a lot of thought. Me and another guy had a call the other day just to talk about content, what we're doing. And that happens a lot. You don't need a paid mastermind group to do some of the stuff. You just call up some friends that are doing some similar things, and you just get together and talk shop and whatnot. And we were talking, and you do a lot of your own research and for your content and whatnot. And let's talk about those newsletters. Like, what has changed over the years that you started to break down these item 19s and your takeaways out of these different brands that you look into and ultimately put out in a newsletter?
I'd say, I mean, the financial side of it has actually stayed fairly consistent. Like I kind of made it up for the first month when I started it, where, I mean, so I guess the context is I was working for an FSO at that point, and we only had a couple brands. I obviously knew there's a lot more to franchises, like a lot more brands out there. And that was part of my role at the FSO, was to find other franchises to partner with. But for the newsletter, I actually really like broadened it out. And that was like a great just learning experience. Like it was boring at times, but just reading through hundreds of FTDs. And so after covering 3 or 4 or 5 brands, my kind of process was, if they show some form of profitability, whether they're defining it as EBITDA or net income or net profit, the brands that have at least ideally 1/3 of their, like, EBITDA represents at least 1/3 of the high end of the investment. I found a theme that there's, a number of brands, like hundreds of brands that can do that. And then if they don't show EBITDA, then their revenue should be at least 2 times the high end of their initial investment.
Because of that, it's likely that the EBITDA number kind of falls into place.
Exactly. Like I'm assuming at least, around a 10% EBITDA. So if it's a food franchise, I'm definitely like banking that in. If it's not ideal, it's probably, I would hope, higher. If it's not, like a pet franchise or a service, like a gutter cleaning franchise, whatever the case is. Although those, the service franchises typically have like a revenue like 10 times higher than their initial investment. But yeah, so that was the financial side of it. I'd say from like the more qualitative stuff, I definitely place more value in some type of like, I don't want to say moat because it's very, it's almost cliche at this point, but like there's a lot, like, let's put it this way. There's a lot of noise in certain arenas, like fast casual. I mean, no disrespect to like someone who's starting a new salad concept, but it's just, hey, like, it's going to be tough. Like, I don't know how the menu can really, how you can get through to the consumer that your menu is that differentiated. And then that obviously flows up to the franchisee. We're like, how is your concept that different from all the other salad concepts or sweet green, whatever? So yeah, just like some type of differentiation. I'm talking now about like the top 1% of franchises, like the ones that grow like wildfire and they can actually back it up by getting units open and having solid unit economics. So, yeah, I think a little bit more deeply about that for like the long term, if someone was to buy a franchise.
Why are these brands not putting information in the item 19? I've got some thoughts on this. Let's share some stories. Let's do a little story swapping, because I've had some very interesting conversations about why certain brands did not put item 19s in. And I'll go first on this, and then you come up with a really good story too. Talking with someone the other day, and they were saying, hey, we don't have an item 19. And I'm like, well, why not? And well, we do about $200,000 in gross revenue. I'm thinking that's not a lot of money for a brick and mortar location that's been open for 8 years. And so I said, what kind of drops to the bottom line on that? And it was just crickets. Well, we need a franchise. So immediately deflection. And they are a franchise right now. 0 franchisees, but they are a franchise. Quick deflection. Well, what we want to do is have a franchisee open this up in a different market with better rent and do higher revenues so we can show what they make in net profit. And so in other words, hey, we're not making franchisor. Hey, we're not making any money. That's why we didn't put anything in the item 19. We've been doing this for 8 years. We have nothing to really offer a new franchisee, but an opportunity to do better than we're doing as a franchisor, so more people can buy this franchise. Our advice to this person was don't franchise, like stop selling franchise. We said the best thing that you did was not get a franchisee. Your life would be harder if you had a franchisee. They didn't like that. They said our life would be easier if we had a franchisee because we would have better numbers and et cetera. We're like, no, you would be in big trouble if you had a franchisee and you weren't making money yourself. So anyway, we went kind of back and forth. We just said, just focus on your own unit level economics and get those up. And at some point you are making money that you're proud to share with people, put that in item 19, then start selling franchises. So that was just a conversation that I had last week, man. But these are stories that I've never really shared before. I'm going to start sharing more of them. I'll never disclose who they were or give any type of hint of who they were. But I'm sure you get a lot of different interactions like that. So what's your story?
100%.
What's a good story that you have?
I think, the way it comes to me is different, right? Like, we're not running an FSO, but people want features in the newsletter sometimes, or they want to sponsor. And, I have criteria where it's like, hey, if I don't see anything in item 19,
if you can write the biggest check, then you're in. Is that the criteria?
Yeah. I mean, some people want to play that game, but yeah, I'm like, hey, like, I mean, it's a good thing that I've almost built up this expectation from the audience, right? Where they're used to seeing the financials in my newsletter. And so like if I was to promote a brand, either like they pay for an ad spot or if I do like a sponsored deep dive, which is not common, but it can be done. Like I need to be able to share numbers because the audience would be like, hey, what the hell? Like there's no data in this one. Like that's your whole thing, man. Like transparency. So I've had franchisors though, a few in particular, both started in COVID. Both raised money to get started. And like great looking brands, I would say very like competent founders, really good founders, good people too, which is like, this is the sad part to me. But like, because they started during COVID and like, I have a lot of respect for the fact that they've been grinding it out. But they've never been profitable. And so like, ultimately, like I was digging out, I was like, hey, like I love everything about this, but like, you don't have item 19, what's going on there? And ultimately, after digging and like kind of beating around the bush, because maybe, I don't know if, I guess as an FSO, I'd probably feel more inclined to just be like, hey, like we don't, like I need to know about this or else we're not partnering with you, because that's such a deep relationship. Sometimes it's a little awkward for me because we're talking about like maybe a one-off sponsorship, but ultimately the answer was like, hey, like we opened during COVID and like we've never been profitable yet. And I'm like, hey, like that's like, again, good on you for grinding it out. I get it. Like I helped start Crockett, software company, not a franchise, but still like it's very tough to start companies. Like so I resonate with like the founders of these companies, but you should not be franchising yet if you've never yourself even had a profitable month. Like that's the opposite. Like the whole point is that you have your systems figured out. So yeah, those conversations when that finally was admitted, I was just like, it's like, really? Like, come on, man. Like you can't franchise it yet if you're not even profitable. So yeah, it's a shame. It kind of boggles my mind.
And makes you wonder in brands that don't have an item 19. Now, some of these like people don't have an item 19 and they still may have profitable corporate locations or profitable franchise locations. So it's not to say that they aren't. They might not be proud of them, or they might not have them in there for other reasons that maybe their attorney's given them some bad information, in my opinion, of not putting in those types of numbers. So, but I'm with you. Like when we do deep dives and we get into it with these founders in a good way of really starting to understand their business. And I understand so many industries that I've never understood before. But that's if the brands aren't making money, I don't know how. Like if their corporate locations aren't making money, franchisees aren't making money, I don't know how they can be part of what we're doing or really sell any franchises. Because if a brand doesn't have an item 19 in there and they don't have any franchises to validate with, how do you as a buyer buy that brand?
Yeah, it's I know I'm not going to name anything. Maybe we should, honestly. But there's some FSOs that exclusively, like they rarely show item 19s in the brands they work with, and I wonder how they're able to sell franchises, but they do. And yeah, it's
let's
crazy.
talk about that, man. Let's talk about some of the sales stuff of ways that you could sell around an item 19, because that might be helpful. I want to help people, man. I got these. This person I talked to the other day, I put out a message the other day on Facebook and everywhere. Hey, who's got some good business coaches or business masterminds that I can put some of these brands in touch with to help them get their business, their small business, into a place where it's highly profitable? So then at some point we can talk to them at Front Street, or they can sell franchises and actually be a good franchisor. So I love to help people. There's buyers out there that are getting sold by good salespeople. So there's difference between a good franchise development person, meaning good, they know how to sell franchises and work around things, and sometimes it's easier to sell without an item 19 because you can dance around that. So how do people dance around no item 19s?
So from what I've heard, like I think a common deflection is they use regulation as an excuse. So they'll say, oh, franchise regulation doesn't allow us to share any financials or projections, which that's partially true. You can't share projections.
Well, the best lies are partially true. So this is great, man. This is great. This is going to help some people.
I really hope it does. Cause yes, you can never project future performance, but you can absolutely share past performance data. And if the data is accurate and it's true and you didn't, add a zero on purpose to the revenue and the EBITDA or whatever, right? Like if it's legitimate data backed by actual financial statements, there is absolutely nothing illegal about that. I don't know if certain franchisors are just using their attorney as an excuse, because the response I've gotten when I've like pressed franchisors, I'm like, hey, like that's not true. And like on Twitter, I'll tag some franchise attorneys that are very open about this stuff. And they'll be like, yeah, the Wolf is right. Like that is totally legal. They'll be like, oh, well, our attorney said it's not. And so like, I don't know if that's a cover up or if there are just lawyers giving bad advice. I don't know. I tend to think it's the former, not the latter.
I think it's both.
But that's a common one, man.
That is a common one. Attorneys do there are some attorneys that give advice of, hey, you probably don't want an item 19 in there. And I don't know why they're doing it. They might be doing it because that's truly what they believe is best for the franchisor from a liability perspective, or it might be an attorney that's not that good. They're just not really good at doing FDD or haven't really understood. They don't really, that's not their thing. They might be, they shouldn't be doing FTDs. I've talked to so many brands, man. They're working with franchise attorneys that are not franchise attorneys. That didn't even make sense. They're working with attorneys who are not franchise attorneys. And they're getting such bad advice. So yeah, as a buyer, what the Wolf said is like, ask them why they don't have an item 19. And if they start to wiggle, it's the law, it's this, that, or the other, then that dig deeper into that. The other thing that you might want to do is look at the competition out there. So if it's in a certain space, look at the competitors' item 19s to see what they have. And now that could be good or bad, because let's say you don't have an item 19 as a franchisor, and your competitor has an amazing item 19. What do? Do you put in a item 19 that's weak, accurate yet weak? Or do you just avoid it and say, hey, look what our competitors are doing. We're better than them. That's another kind of way that some franchisors kind of skirt around that too, to use an amazing competitor's item 19, which is not their item 19. Have you seen that done before?
Wait, where they'll show their competitors?
They'll not show it.
As if it's
they'll
their own?
Hint at it. Hey, why don't you check out competitor A, the biggest competitor that we have out there. They got some pretty good numbers.
No way. Oh my God, I can't believe that works. But like, there are some, I mean this, and this isn't meant to sound like I'm, condoning it, but like there's some incredible salespeople out there that they're able to pull this stuff off. If only like they use their powers for good is like what I always think. It's like, imagine how many franchises you could award if like you were working for a good brand, if you're able to figure it out without the numbers. Yeah, it's a shame, man. There's also like the classic tactic of they'll pretend to geo-target, where it's like, hey, we're actively trying to build in, and like insert your exact location, in this part of the sentence. So it's like, yeah, we're actively looking to build in North Dakota, and like, you're a great fit. It's like, no, they're probably not. They're just saying that to literally every candidate in the country. So yeah, there's some classic tactics, man.
All right,
I hope people can see through it.
I do too. Let's go on the other direction. Great brand.
Yeah.
Say it's a great brand. Franchisees are making really good money. Kind of industry standard, good money. Brand does not have an item 19. How? And they just heard us just blast these brands without item 19s, and they're like, I need to run. These guys are, snakes. And that's absolutely not true with a brand. They're good people, good franchisor. Franchisees aren't making money. Yep. They don't have an item 19. How do prospective franchisees know if they are a good brand? Maybe just doing things wrong, just not putting in item 19s. And they're not really, we're not really snakes. How does a buyer navigate that?
I would say talk to as many franchisees as possible, which like that's always the advice that, right, you should do anyway, regardless of the item 19 or not. If you're seriously considering a brand, talk to as many as you can. And I think like a good example is, Jersey Mike's this past year included financials in their FTD, but they hadn't for many years before then. I think it was like 7 or 8 years in a row. But I've never heard anything but amazing things from the people who own that brand. And obviously, like, they've grown a lot, which doesn't always mean that the franchise itself is doing well. However, from everything I hear, like, it's just positive. And then their average unit volumes are really good for a sandwich franchise. So, I think talking to franchisees, it would be my like first go-to as step one.
So let's dive into that a little bit deeper on how to validate with franchisees of a brand like that. One of the things that you can do is pull up competitors' FDDs. You kind of see what, and just, pull up what you think is kind of industry standard. Maybe it's $1 million in revenue, 30% net margins drop to the bottom line after royalties, all expenses, etc. Maybe they say, hey, you're breaking even, cash flow break even after 6 months. And let's say all of that is true with competitors. Brand doesn't have an item 19. We look at Front Street when we're looking at brands that to partner with that become portfolio brands. We look at their competitors' item 19s and to make sure that they are in line with that. We don't want them to be huge outliers either, because something's wrong if they're huge outliers either way. So anyway, you can do the same thing as a prospective franchisee. Look at the competitors, see what they're doing, see what their average franchisee is doing, or maybe the top third, top 25%, and then validate, like you were saying, validate with the franchisees of this brand that you're looking at without an item 19, and see if those franchisees are doing those types of numbers. Because I'd like to have a base to start with. And that would be kind of the base that I would start with to start validating. What would you add to that, or maybe not even agree with?
I would definitely, no, I agree with that. I would say to add to it, understanding this, I think a lot of folks, maybe they just hear like whatever the top line and bottom line is, and then just think they might hit that in year one. So like understanding that the ramp up phase that the franchisees have gone through, and that relates specifically to the amount of working capital you're going to want on hand. I've heard some franchisees, they double the initial investment that they see, and they want that amount in their bank account in case it takes longer to ramp up before they, their location can fund all the expenses. So understanding that is like, is this a 2-year payback, 3-4-year payback, et cetera? That's key. And then also understanding like the location that each franchise in. And that's tough because like this is a lot of work. It's intense research if you want to do it the right way. And you really want to understand like where is each franchisee located, and how does that correlate to their revenue, right? Because like that matters so much for the brick and mortar businesses. If you're talking to all the top performing franchisees and they're in like what we would define as an A location, but then you just think, oh, like this concept's good, and then you open up in a C location in your territory, that actually could make a big difference depending on what concept you're buying. So like for real estate franchises, brick and mortar franchises, there's a great quote by the Zaxby franchisee who I've become friends with. And he says, you can pay for your location once, or you can pay for it every single day. And he's saying like, if you pick a bad location, you're going to pay for it every day because it puts a hard ceiling on your revenue potential. So yeah, for me, man, real estate and ramp up time are critical things to understand in addition to everything you said.
So to piggyback on ramp up a little bit more, I think this is what a lot of people that are getting into franchising don't understand. I think it's good to ask the ramp up. Ask, are there any outliers in your ramp up, your first year, 6 months, year, that had an impact, positive or negative, to your particular story? Because you could get on the phone with somebody and validate and say, hey, how's it going? Great. You making money? Yeah, making a lot of money 6 months into it. That's awesome. How much money did you make 6 months into it? $100,000. That's awesome. Okay, so quick math. Gonna make $200,000 my first year, and I'll probably continue to do more. Click, hang up. I'm ready to buy. But to do a deeper dive, hey, why do you think that you were able to do $100,000 in your first 6 months? Is this normal? Is this an outlier? Well, we just had a big storm come through here that caused all of the houses to flood, and we're in the restoration business. And so I've got all kinds of work. Nobody else is making this kind of money, and that's a true story. I heard that from somebody.
God.
So yeah. You just need to dig deeper into finding out if they are outliers and why, versus just saying, okay. So another one is in brick and mortar. If someone was to validate with me when I owned owned Salon Suites, if I still owned them, they would say, "Hey, how quickly did you break even?" Very quickly, sometimes month number 1, and they would say, what's kind of your net margins, your EBITDA margins, and I would tell them, and then click, they go by. Well, what they weren't asking me is, when did I sign my leases? What was out of the last recession when I was getting amazing deals and still able to have margins that nobody else gets because I had those types of leases. So people just need to dig a little bit deeper versus just asking, when did you break even? How much money are you making? And would you do it again?
100%. And that's an interesting one, the lease pricing. Something that I found that's happened a few times is someone's doing due diligence and they hear the net margins and it looks great. But what the franchisee didn't share, and not necessarily like they weren't purposely withholding information, but something that I just think everyone should ask is there are certain franchisees who they have a general manager, but it's their wife who isn't on the payroll, or it's the husband who isn't on the payroll. And they also, by the way, have a few of their kids working for free or like minimum wage because, it's a family business. I mean, if you don't have that option as a franchise owner to, have a spouse kind of team up with you, all of a sudden that's potentially 60 to 100 grand for an actual GM to run that thing semi-passively or, semi-absentee, whatever we're going to call it.
So on the flip side, what happens if someone, you're validating with somebody and they're like, hey, I'm not making any money. I'm working pretty stinking hard. This sucks. And that scares off that buyer. What the buyer didn't know is this franchisee's paying themselves $400,000. They're paying themselves, and they're not including that into the EBITDA margins or net operating margins. Is that where you were going?
Yeah. So it really can go both ways. Yeah, exactly. So it can go both ways. And I think it's just like people should probably prep before the call to like really think about, because if you just come out and ask, right, how much money are you making? Or, just go direct and blunt, it's pretty awkward, I would say. So you kind of got to just strategically like think about how you want the conversation to get to this point. But like you absolutely should be asking these questions. And, it's fair to ask. I would imagine most franchisees are receptive to it because at a certain point they were the person on the phone as the prospect. Just a funny tidbit. Just one thing. Someone I've become friends with in the industry, he's been a franchisor and a franchisee, but every time he does due diligence, he starts with the New York City and the New Jersey and the Philadelphia franchisees because he's like, these East Coasters, they're just going to tell you exactly how they feel right away. So that's his golden nugget for how to really get to the truth as quick as possible.
That's a good golden nugget. Yeah, they're going to tell you exactly. And they're kind of the worst candidates to get when you're selling franchises too. You're like, these guys are going to be so hard. They just tell you like it is and they don't care. But that's a good point when it comes to validating. Talk to those New Jersey, New York, Philly franchisees. You'll get the straight scoop. Yep. I like it. All right. So we've been just, whenever we get off a call with a franchisor at Front Street and just kind of giving them some advice, most of the brands that we talk to, we'll never do anything with, but we always try to help them with something. And my comment about franchisees making money and not realizing they're making money because they're paying themselves W-2s, high W-2s, which is another thing they probably shouldn't be doing. But if they're paying themselves high W-2s and they don't really think that they're making money and they're validating that they're not making money, that's a problem because they actually are making money, but they don't think that they are. So franchisors out there, this is happening in your system. I think you probably need to help franchisors understand their financial model. And I think a lot of franchisors out there are not really helping their franchisees understand their books, kind of money that they're making, and help them with that and manage their business by the numbers. What do you think about all that?
Completely agree. And like, especially the last few months, I've had a lot of direct experience with that. And this actually ties into the Ed19 conversation as well. So with Crockett, the software company I helped launch, we have an API that integrates with basically every accounting software out there, as well as a lot of point of sale systems. And we have banking integrations coming soon. So it's a tool for franchisors to not only track all their financials, consolidate those 3 tech stacks into one, but then they also get that ability to see how all their franchisees are doing in an apples to apples format. So we help them standardize the data. So a lot of them just, they're not using a tool like that. I think franchises as a whole probably, as an industry, it's a bit behind like a lot of other industries from a tech perspective. But we're obviously trying to change that. But as far as like the item 19 conversation, that's actually a reason I found, because we're speaking with some multi-hundred location franchises that they don't have an item 19, and it's they've said, and I trust generally actually the brands I'm referencing. I can't say the name because they're not a client yet, but that they're not actually just sharing item 19 because they just kind of didn't focus on their tech stack, and they literally just don't have access to the financials. Every franchisor from day one should have a standard chart of accounts. That way, when you're trying to see your franchisee in Omaha versus your franchisee in New Jersey or whatever, you can compare their labor in an apples to apples format. And, do they have salaried labor, their utility costs, everything, like, right? It gets so hard at scale if you're not standardizing it early, and you just create a massive headache. Obviously our tool can help with it, but it's still work to unwind that kind of data mess if you don't start it early.
So I think this is advice that we give to any brand that we're working with. We give it to a lot of brands that we just talked to as well. So how does Crockett help with a brand that does not really have that type of has not really had that type of focus? They just really didn't put that a high level of importance on it. It wasn't a focus of theirs. So how does Crockett help that franchisor, which ultimately helps their franchisees?
Yeah, so I mean, one, the tech platform helps standardize it. So we have like a AI-backed chart of account matching system. So franchisees integrate their accounting software. Takes 2 minutes to integrate, so it's super quick. We sync all the data, and then the franchisor just checks off to make sure that the line items or the accounts, right, from the franchisee's income statement and other financial statements map to the correct line item of the franchisor's master chart of accounts. So a little bit getting into the weeds of the accounting world here, but that's what you have to do as a franchisor. And then secondly, we have a few partnerships with some bookkeeping firms that are professional, reputable, and they're big enough to work and take on franchisor clients and all their franchisees. So that's not like necessarily mandatory, but to me, it's a good option. I'd be curious for how you think about that. But just to have all your franchisees using a specific bookkeeping firm so that you don't have to worry about, because I mean, I've seen it just with the brands we've already onboarded for Crockett. I mean, you have franchisees using their cousin or their uncle or trying to do it themselves. And they end up kind of going outside the lines, and it just creates issues for everyone, honestly.
It's tough. I think bookkeeping, I can see that. I know brands that have required bookkeepers or a few different types of vendors that are bookkeepers. I'd like to see a couple vendors, 2 or 3 vendors that kind of can all talk versus one. It's hard when brands have just one. Franchisees tend to think the franchisor is just making a bunch of money off it. And that may or may not be true. But even if they are thinking that it causes that kind of strife or could cause it. So I try to avoid that as much as I can. But I think it's better for the franchisees ultimately if there was a standard chart of accounts, standard way everything is done. Franchisees have visibility into certain KPIs across the system to see where they fall and gamify it a bit. So I like all of that stuff.
Yeah, I think ultimately transparency usually is the best way, right? I mean, even if things aren't, God forbid, aren't going well, if you have no visibility, like it usually just makes the system kind of and the franchisees antsy because they're not doing well. It's isolating almost. So I think really in good times and bad, you'd rather just be kind of upfront with everyone. So it's there's a lot to think about, man, for franchisors. So I sympathize with them.
All right, last question. Where are you going to focus your energy in the next year on social? Are you going to double down on Twitter? Are you going to continue that newsletter? Are you going to switch anything up? You test anything on your own content generation stuff?
So the newsletter will stay consistent. The podcast, I'm going to change up the format. I do like a weekly interview similar to you, and it's a grind. And I also feel like I've let the quality slip a bit because I just don't have as much
especially
time.
Now, I'm coming on there next, and so That quality's going to go way down. So thanks for throwing me under the bus. Like, you looked right at me. We are literally recording right after this. He said, hey, the quality's getting ready to slip big time. So I won't forget that. All right, keep going.
For the record, I was referencing not the guest quality, just my interview preparation quality. But that's funny. Yes, you are up in 3 minutes here. Yeah, but like in all seriousness, I just don't have the time to like prep for these interviews and really ask the questions. I kind of go through the motions sometimes, and that's part of what makes content hard. Is it's you always kind of feel this need to you have a good piece of content, but it's like, okay, what's up next?
Yeah,
because it's a never-ending game. And so the podcast will change a bit, but I definitely want to get back to doing more content. I've been heads down, kind of guiding the product team within Crockett. As well as doing some sales work actually, and like reaching out to franchisors, getting them onboarded. So we've got good success in the last few months here. So now that I think we can eventually get a sales person into Crockett and kind of lead that team of getting more franchisors onboarded and consolidating that financial tech stack. Ideally, I just can focus more on Twitter and LinkedIn.
All right, everyone should find your newsletter. Everybody should. I don't have very many newsletters that I read. I read yours every time you pop it out. How do people find that? How do people find you in general in Crockett?
Yeah. So Crockett, you can go krokit.com. We did not spell it like Ray Kroc's family because our lawyers advised against that for liability purposes. But the Wolf of Franchises you can find at wolfoffranchises.com. You can Google the Wolf of Franchises. I think I am the only one with that name so far. So it'll probably come up pretty quick. And feel free to DM me on Twitter, reply to the newsletter. That's me on the other end of it. It's not like a team. It's just me. So happy to help if I can.
Dude, thanks for coming on.
Appreciate it, Eric.
All right, man. See ya.
Thanks for listening to Franchise Empires. We're coming to you soon with actionable insights to take the next step on your franchise journey. So make sure to subscribe on Apple, Spotify, Google, or wherever you listen.